This video will cover common stock valuation. Specifically, we'll look at the dividend discount model. I'll provide a brief introduction into discounted cash flow valuation models. And the reason for covering this topic is that the value of any financial asset is the present value of its future cash flows. So what we need to do is we need to define cash flows. We need to project them out into the future using assumptions about growth. And then we need to discount those cash flows back to a present value. The dividend discount model is one type of discounted cash flow model. We will look at in other videos a free cash flow model and a residual income model, each of which complement each other. So it's interesting to compare and contrast the models. And that'll get done in a series of videos. We'll discuss the dividend discount model here in this video and its assumptions. Then we'll discuss dividend growth and its sources. And we'll cover the discount rate, K. And like I said, as there will be other videos, free cash flow and then residual income models, that will follow. And it's all based off of this video. So this is an important starting video for the cash flow models in general. So since we're using discounted cash flow models here, some understanding of time value of money concepts are very important, especially present value. Understanding present value will not only help you in this video, but it'll help you in the video that covers free cash flow methods of valuing common stock, the residual income model of valuing stocks, and then when we get to bonds, present value is very important. Again, why is time value of money and specifically present value so important in finance? Because the value of any financial asset is equal to the present value of its future cash flows, and hence time value of money comes into play in finance. Let's not lose sight as to what we're doing. We're trying to, in this video, understand what are the drivers to valuing common stock and how do you go about valuing a common stock. Is the common stock you see traded on the New York Stock Exchange appropriately valued? Is it a good buy? What are the growth rate assumptions that are built into that price? How much risk is in there? That's what this video will help tease out. The importance of this video and the series of videos on discounted cash flow models goes well beyond valuing a specific common stock. You might have questions about, well, how much is your small business worth? If you want to buy a business, how do you value it? How much do you pay? If you want to buy a laundromat, you want to buy an apartment building, you want to buy a pizza parlor or a painting business, the value of all those businesses is equal to the present value of the future cash flows those businesses generate, discounted back at an appropriate discount rate to come up with a present value. So my point is, this is not just about valuing common stock, it's also about valuing businesses in general. So let's value a common stock using the dividend discount model. Now, as I said before, the value of any financial asset is the present value of its future cash flows. And what distinguishes the dividend discount model versus other models is the cash flow is dividends. So here we go. We're going to estimate the stock price today. So P is the price, time subscript 0, at 0 time, subscript 0. And this hat stands for an estimate. And so let's go to the price will equal the future value, the present value of future cash flows. All the way out to infinity because a stock never matures. So here's what's going on. Let's make sure our timing is very precise so we better understand this. So here we have a timeline that goes on to infinity. We are right here at time 0. And notice, this is a stock price today at time 0. Right? And it's the present value of these future cash flows that we're going to add up here. So this is the dividend in time 1, the dividend in time 2, and the dividend in time 3. So 1 year from now, let's think of everything on an annual basis. That's the easiest way to do it. 1 year from now, we're going to get a dividend. 2 years, we're going to get this dividend. And 3 years, we'll get this dividend, D3. Now the timing is very important because right here, D subscript 0, that was the dividend that was for the last year back here, right? That was just paid. So it's out the door. It's not part of the cash balance of the company. It's gone. It's in investors' pockets. So the value of a stock today at time 0 is the present value of its future cash flows, not past cash flows, future cash flows. And those future cash flows need to be discounted, and they're discounted at the rate K, which I'll talk about shortly. Now, keep in mind that then if these dividends are exactly 1 year apart, this dividend D1 was paid just before the end of year 1. And the same with D2, just before the end of year 2. This dividend was paid and so on. But, you know, we have a huge problem with this model. I mean, this is the workhorse of cash flow models. And so cash flow models generally have, there's some type of cash flow up top on the numerator. In this case, since we're using the dividend discount model, the cash flows to a stock, the cash flows associated with its stock that goes out to infinity is the dividends that the company generates and declares and pays out. So when we look at other estimates of a stock price using other types of cash flow, we're going to have different types of cash flow in the numerator. And if we have different types of cash flow, we're probably going to have different discount rates also, and so we need to discuss that. Now, before we go further, well, we can't really go further. It's almost useless to try to go further given this scenario. I mean, this is the correct way, without a doubt. This is the correct, theoretically fundamental correct way to value a stock because it reflects all future cash flows, and we're discounting, taking time value of money into consideration with both opportunity cost and risk embedded in K, the discount rate. So this is theoretically sound, but we can't do anything. And what we need to do is we need to do a couple of tricks. The main trick is to assume a constant growth rate in dividends. And if we do that, we can get rid of this infinity sign with a couple of other tricks. So what we're going to do is, look, we're going to say, let's translate this D1 as a function of D subscript 0. So what we're going to say is, look, we have a dividend here. Let's just say the dividend for this period was $1. Keep it simple. And let's just say we have some growth rate. We take that dividend, grow it for one period, we get D subscript 0. So if this is $1 and the growth rate is 5%, then D subscript 0 is $1.05. And then we keep compounding it out. So we'd grow this by 1 plus G to the 1 power, we'd get D subscript 2. And that would be, get my calculator out, this would be 110.25, like about a little over $1.10. And we compound it out. So my point is, we're just going to assume constant growth forever. And so we go out 5 years, we're just going to take $1 times 1.10 to the 5th power, and we'll get D subscript 5 way out here. And that would be, just to check here, let's make it 05. Be consistent. 1.05 to the 5th power. This will be over here at D5. This would be $1.2763 approximately. And so that would be 5 cents compounding, $1 compounding at 5% for 5 periods. Okay, so all I'm assuming is constant growth. Everything grows, everything right here grows. This grows at rate G, this grows at rate G, this grows at rate G. Okay, so now let me clean this up. So just rewrote what we had before with the constant growth rate G embedded in there. Now, okay, so we got that part. Now let's do one more math trick to get rid of this infinity sign so we can make some practical use out of this formula. And the way we're going to do it is we're going to multiply both sides by 1 plus k over 1 plus g. 1 plus k over 1 plus g. We're going to multiply both sides out. Okay, that's an infinity sign there. And so here's what we have. I multiplied it, I put it in detail here for this first term. So I took this term right here, and that's right here, and I multiplied it by 1 plus k over 1 plus g, just like I multiplied this over 1 plus k divided by 1 plus g. Notice what happens. Cancels, 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 and cancels, and all I'm left with at this point, this term, all I'm left with is this. Okay? Now, I kind of left a step out here. I had multiplied this term, so I had multiplied this whole thing by 1 plus k over 1 plus g. Basically, these squared terms drop out. Okay, they drop out. This was 1 plus g over to the third power. Now it's to the squared and to the squared and so on. And so all I did was multiply every component right and left of the equal sign by 1 plus k over 1 plus g. Okay, so that looks like a total mess. It doesn't look like I got anywhere, but I did actually. Call this equation 2, call this equation 1. I'm going to take equation 2 and subtract equation 1. And you're going to think, holy mackerel, what, this is going to be a total mess, but work with me here for a second. Equation 2 minus equation 1. So for this side of the equation, I took this minus this, and there it is. Now I want to take this and subtract this. There's no single by itself d subscript 0 anywhere. So it just translates. There it is. There is no single d subscript 0 up here. Okay? Now what I want to do is, let's see. Let's look at this. See this term and this term right here? They're identical. This term and this term. So when I take this and I subtract this, it disappears. I take this term and this term, which are identical, they disappear. And the same thing would happen all the way through, right? And it would cancel out. Not only that, but these terms would basically go down to 0. By the time you approach infinity, these terms approach 0. So what we have is we have nothing on this end. So nothing. Look how much I got rid of all of this mess right here. And it all boiled down to d subscript 0. Now this looks a little nasty, but it's really not. It's just a matter of collecting terms. Okay, then get a common denominator of 1 plus g. Okay, so let's get that common denominator, and this looks like this. Now let's get into something. So we want to get this price on the left hand side all by itself. So we get p subscript 0. And by the way, I left the hats out a long time ago. I just get rid of that because I'm not going to carry that hat all the way through. But at the end you can put the hat in. I'm just not going to write it out. And that'll equal, an estimate of today's stock price will equal d subscript 0 times 1 plus g over k minus g. So I'll bring it over here. And that is stock price today equals D1, that's D1, divided by k minus g. And so there we have it. This is the constant dividend discount model right here. Constant dividend discount model. Let me clean it up a bit so we can work with it. Now, keep in mind, I'm not going to ask you to derive it, but the point is of me deriving it is to show you that it doesn't come out of a black box. With a little bit of algebra, you can figure out how to get rid of the infinity sign. So now back to this model. It's often shown that k is greater than G. When you see this formula, you often see it in the textbooks with K greater than G. That's because the discount rate has to be bigger than the growth rate. Otherwise, you get an infinite stock price with the growth rate G. If you get G bigger than K, you can see, oh man, that's a negative stock price, but that doesn't make any sense. Well, the math was assuming that, all the math we went through was assuming that the G was smaller than K. So we would get a finite stock price. So now let me show you the interaction of K versus G, how they interact under the constant growth model. So let's take an assumption. Let's look at a dollar dividend right now, D subscript 0. And D subscript 0 at say a 10%, let's use a 10% growth rate. So that means D subscript 1 will be $1.10, and then D subscript 2 will be $1.21. Okay? But now we have to look at the discounting part of it, right? So let's say that K is 7% here. And so 1.07, 1.07 squared, that's to the 1 power. We end up with 1028 plus 1056, so on. And we keep doing that. What I'm showing you here is that if G is bigger now than K, the numerator keeps getting bigger and bigger and bigger, but the bottom of the fraction doesn't keep up with it. It's smaller. So what happens is each one of these terms gets bigger and bigger as we go. This is like $1.03. Now this is almost $1.06, and it'll keep getting bigger. Well, if you go out to infinity with these terms getting bigger, you get a stock price today that approaches infinity. That's no good. You don't see stocks approaching infinity. I mean, they get kind of high in some cases, but they don't go near infinity. So there you see, if you have a G that's too high, you're going to have an infinite stock price. And so G too high shows up as a negative stock price here in this formula, only because this is a compact way of modeling the stock price under the assumption of constant growth. Now, what would happen if we did the opposite? What would happen if we followed this and we said, let's say K is 10% and let's say G is 5% growth? Now, what will happen is we end up with $1.05 for D1, $1.05, and we're going to discount it back at 10%. Okay, and that comes out to be 95 cents, a little more than 95 cents. And then what about D2? Well, multiply that by 1.05, you get 1.1025. And then we discount this 2 periods back, and this comes out to be 0.911, 91 cents. And so you keep adding all these terms. Well, these terms keep getting smaller and smaller, so it collapses to a finite stock price. So P is finite when K is greater than G. It's a long story to show you that K must be greater than G. Let's look at what K represents. So recall what K is. K is a discount rate. It is equal to the risk-free rate plus beta of the stock, which I'll explain in a minute, times the expected return on the market minus the risk-free rate. So, I use RF for the risk-free rate so it's clear. Sometimes the textbooks use just a little R. I'm just going to use RF. It's clear. So what you see is, as I've been saying, K represents the opportunity cost of money, because you have to drop your money into a stock, meaning you got to take your money out of a bank account and put it into a stock. Well, your bank account, all else being equal, would earn the risk-free rate. So your stock has to earn at least the risk-free rate, assuming it had no risk, assuming this away. Now, a measure of risk is your beta. And then this represents the risk premium on the market, the equity risk premium on the market. So it's the market risk premiums, the excess return, the return over what the risk-free rate is. So, I like to use a 12% expected return on the market. And, interest rates are really low. Let's say they're 1%. So that means you expect to earn 11% on the market per year, doing this on an annual basis, per year for just the risk you're taking with the market itself. Then it's the same 1%. If this is 1% for RF, this has to be 1%. And so then you have a model that says, look, the risk-free rate in today's world is 1% plus whatever the beta of the stock is times 11%. That's going to be K. So beta, recall, beta for the market is 1.0. And a stock with a beta greater than 1 means the stock is riskier than the market, and a beta less than 1.0 means the stock is less risky than the market. Let me show you. So here we're going to have the expected return, which equals K, and I'll explain that in a second. And here we have beta of a stock. So with the risk-free rate at 1%, this is your opportunity cost, assuming beta is 0. So this measures, remember, it measures market risk, systemic or macroeconomic risk. And we have this slope of this line. And many people think that the slope of the line is beta, but beta is here. The slope of the line is the expected return of the market minus the risk-free rate. That slope is 11% in this example, although it doesn't quite look like 11% from my geometry here, but just work with me. Assume that's a slope of 11. And so we have the average stock in the market. The average stock has a beta of 1. Stocks that are riskier than the market are up here. So if you find the stock has a beta of 1.20, you come up, you come over, and you're going to get the expected return on that for that particular stock. So plug in 1.2 here. If you plug in 1.2, we'll get 14.1% plus 1.2 times 11% equals 14.2%. And so this would be 14.2%. If you plugged in a beta of 0, well, you'd be right here with 1%. If you plugged in a beta of 1, you would get 12%. You don't even need a calculator to see that. You'll get 12%, and boom, boom, up to here and over. It equals the expected return on the market, just like we had assumed. If your beta was 0.5, it would be what? 5.5 plus 6.5 would be right here percent. And so the point that I'm making here and refreshing your memory on is that the discount rate reflects the opportunity cost of money, and that assuming there's no risk. And then you need to have a risk component. This measures the risk component for the stock. And that risk component is a function of the market risk premium here. The market risk premium is this slope. And so this line is this equation. Well, let me just go a little bit further into this. This is the expected return on a stock, and I'm saying it's got to equal K, the discount rate. Now, what's that all about? Well, let me explain here. When we're in equilibrium, meaning the stock market is in equilibrium, the supply and demand for the stocks are all equal, we're going to be on this particular line. Let me make it in red here. So we're on this line when K equals the expected return. So when the stock market's in equilibrium, there's no excess returns, supply equals demand, we're on this particular line right here. Let me clean this up a bit so I can show you better. So here I've redrawn the graph, and let's assume that we have an expected return for a particular stock. Okay, expected return for stock I, that's what that says. And let's say that the expected return is way up here. And that, if we looked at it, we did our calculations, let's say, given its risk, we would assume, and we're on this line here, we would assume that the return of that stock should be 13. But let's say we think the return, as an individual, we think the return on this particular stock should be 16%. That means this is an attractive stock by 3%, because given its level of risk, right here, its beta, wherever we are here, beta down here, this is an attractive stock. if it's an attractive stock, that means it's undervalued at this point. So when you're above this line up here, the stocks are undervalued. And so this is an undervalued stock because the expected return is greater than the required rate of return given its risk. So K, this formula, is often thought about not only as a discount rate, but it's the required rate of return given its risk. So sometimes it's called required rate of return, RROR in some cases, in some textbooks. And so here we say the expected return is greater than the required rate of return given its risk. It's an attractive stock, which means the stock is cheap. So what do people do with cheap stocks? They buy them, push up the price, and whoever buys them now, once the price is up, the expected return comes down. So you know there's an inverse relationship between stock prices and returns. So the price goes up, the return goes down. Well, when your return goes down, you move down to this line. If the opposite happened and we had an expected return that's really low, this would be an overvalued stock, as the expected return is less than K. The market is demanding K. This rate, market's demanding 13% in this case, but this stock is only generating 10%. That's an unattractive, overvalued stock. So people sell the stock, and whoever buys it now has a higher expected return because they bought it at a cheaper price. And so the return's going to go up. Now what we want to do is let's look at what drives growth, because that's a really important question. I mean, think about it. There's an entire area of the market called growth stocks, and figuring out what a growth stock is. So if we're a growth investor and we buy growth stocks, growth in what? And where's it coming from? That's what I want to address next. So let's look at growth and look at it under the microscope. Growth in what? Growth in dividends. Because that's what we just grew, dividends, with G. So we have a stock price model using the constant dividend growth model, but underneath the constant dividend growth model is a model for the growth rate. And here it is. It's called the sustainable growth rate. And so this represents the return on equity of a firm, net income divided by equity. And then this is 1 minus the payout ratio. And the payout ratio is, think of it as dividends per share divided by earnings per share. And so if a company pays a $1 dividend and it earns $3 per share, it has a payout ratio of 33%, which means if this is a 33% payout, what is this? This is called the retention ratio. It must be retaining 67% of its earnings. Okay? Now, that gives you some of these terms here, and we'll elaborate on each one a little further. But now look what happens. What happens if your profitability is zero? Growth rate is zero. What happens if you pay out 100% of your earnings as a dividend? So you earn $3, you pay $3, you don't retain anything. Well, if you don't retain anything, you don't have any growth. You need retention and you need profitability to get growth. It's just like your bank account. If you have a bank account and it earns a rate of return of 10%, right, and you don't withdraw anything, there's no payout, so the payout is zero, then that means you retain 100%. So your bank account earns 10%, you retain 100%, your bank account balance will grow at 10%. Now what happens if you pay out, in other words, withdraw half of the money? So your payout ratio is 0.5. You pull out half your money and you still have this 10% growth rate. What is the growth rate in your bank account? It's going to be half of 10%. It's going to be 5%. So my point being here is that firms grow kind of like your bank account. You need to have some profitability or a rate of return, and then you need to have some retention. You need to retain money for it to continue to grow. You can't keep paying money out and expect growth. So with that said, let's look at this a little more closely. It turns out that your net income divided by equity can be broken out into some additional variables that give you some more intuition about what drives growth in firms. First of all, it's net income to sales. This is a measure of profitability. And then you have sales divided by assets. And this is sometimes called asset turnover, and it's a measure of how effective your assets are. So if your assets are really small and you got a lot of sales, it means you're really efficient at producing sales because you don't need much money tied up in assets. So you want this number to be high. This number you want also to be high, by the way. That should be intuitively obvious. You want your net income to be really high relative to your sales. And then there's one more term that's here, and this is assets divided by equity. This is a measure of leverage. How does that measure leverage? Well, let's come up to here. If you have your balance sheet and you have assets, liabilities, and have equity, right? And then if your assets are really, really, really big and your equity is kind of small, it means you've got to have a big liability section, right? So for this number to be big, it means you got a lot of assets relative to equity. The only way you can do that is you must have a lot of liabilities. And so that means you've borrowed a lot. So that's why it's a leverage ratio. So my point being here overall is that the growth rate is determined by your profitability, your asset turnover, and your leverage, and then how much you decide to retain. So the board of directors determine the payout ratio. They decide the dividend. So they decide retention. The management of the firm is working hard on keeping return on equity strong. And it's composed of these components. So we're working with the constant dividend growth model, and we now have a sustainable growth rate. Now, as I said earlier, there's implications underneath this. So we're assuming constant growth in dividends, but it turns out other things are growing at that constant rate G underneath the model. That's kind of hard to see. And what I want to do is I want to build a table and show you what else is growing at rate G under these assumptions. And so what we're going to find out is that the constant growth rate model implies that dividends, and that's right here, we know dividends are growing at a constant rate, but it also implies earnings per share are growing at a constant rate. And then that means the stock price will be growing at a constant rate G. And hence that's why, you have people who are devoted to growth investing, and they are devoted to growth investing because if they can find stocks with high G, that means they're going to have a high capital gains rate and a high total return, all else being equal. The constant growth rate model implies dividends, earnings per share, and the stock price grow at rate G, and that the total return on the stock, well, we know what the total return on the stock is. The dividend yield plus the capital gains. And so I'm going to show you, look, that this model is consistent with our total return calculations. And then what we'll see is that the dividend yield remains constant when we assume sustainable constant growth. And you can kind of see that here. The dividend remains the same because we're assuming a constant payout ratio. So let's build a table and let's explore the implications of assuming constant dividend growth. I'm going to explore this issue with an example. Assume Pulsar Corp, right, has the following data. Let's say it has no debt, has a payout ratio of 50%, so every buck it earns in earnings, it's going to pay out 50 cents in dividends. Let's say it has a return on equity and a return on assets equal to 15%. That's consistent with the fact that there's no debt. So, go back to the balance sheet that I keep showing you all the time. Well, if you have no debt, you have no liability, so your equity side equals your asset side. So therefore, your return on assets equals your return on equity, and we're going to assume that that's 15%. We're going to say that our earnings per share will start out at $2. We'll use K, which is the required rate of return given risk, and that's 15%. And so the firm's cost of capital in this example is 15% also. So now, given this information, let's build a table where we watch earnings per share grow, dividends grow, and dollars retained grow, and see what the implications are. So before we go further, let's figure out what the growth rate is, because I haven't given you a growth rate. We know that G equals the return on equity times 1 minus the payout ratio. And we know return on equity is 15%. We know the payout ratio is 50%. That means this firm has got to be growing. At least its dividends are growing at 7.5%. Now what I want to do is show that. Let's see what happens. So here's what we're going to do. Let's build a table. Let's look at the intuition. Okay, so here's the table that I'm going to build out. Earnings per share, dividends per share, dollars retained on a per share basis, and then the retained growth, how much the money that we've retained is growing by. And so if you look at the data given, we start out with $2 per share. That's, remember, E subscript 0, earnings per share times 0 were $2. Okay, that's easy enough. And dividends have to be half of that because the payout ratio is 50%. So this has to be $1. If we earn $1 and we pay $1, that means we had to retain $1. So therefore, what we retained and what we paid out equals our earnings per share. All of that makes sense. Now, what we're going to do is we're going to keep this $1, right? It's retained, and that $1 is going to earn the return on equity of the firm. And so it's going to earn 15%. So basically, we're going to earn 15 cents per share from that. So far, so good. Now, if we retained $1 and it grew 15 cents, right? Then our earnings per share now must be the $2 plus what we retained, that 15 cents. So it's got to be $2.15 that the new earnings per share represent. And the dividends per share have to be half, so this is $1.07.5, right? And if we retained $1.07.5, we earned $2.15. We retained $1.07.5. So those two things add up to earnings per share. So that makes sense. And now we're going to earn 15% on this, which means we're going to make about 16 cents. And so we're going to earn an additional 16 cents onto this $2.15. This is $2.31. And then this has to be half. That's half. And this has to be the same number because we have a payout ratio of 50%. And then this has to be about 17.3 cents per share, which means add that on to your last year's earnings per share plus the earnings you're going to get from the retention will be $2.48. And we could continue down the table, but there's no need to. Now let's look at the stock price. Right here. Let's see. The stock price. What do you think the stock price is right here at time 0? Well, remember the stock price according to the constant growth model is P equals D1 divided by K minus G. Oh, D1, here's your dividends per share. $1 and almost 8 cents. K is 15% is given. The growth rate's 7.5%. And this turns out to be $14.33. The stock price is $14.33 given this information. Okay, not so bad. Now, what about this stock price here for period 1? Well, it's going to be this period's dividend divided by 0.15 minus 0.075. And that will be $15.41. And then we do the same thing here. And if we were to go further, this would be about $1.24. And I got rounding issues all along the way. And so we're going to need this $1.24 divided by 0.15 minus 0.075. This comes out to be 1653. Now let's look at what happened. Notice what happened. Growth rate is 7.5. The growth rate is 7.5%. Notice what happened. Earnings per share are growing at 7.5%. What do you know? Dividends per share, they're growing at 7.5%. Retained earnings, dollars that were retained, are growing. And then look what happens here. Look what happens to the stock price. This is growing at 7.5% also. So earnings per share, dividends per share, and the stock price are growing in at 7.5%. Now, is that consistent with the total return story that we've been looking at? This is the capital gains component of our stock. What's the dividend yield? We have to calculate a dividend yield. So if we calculate the dividend yield must be 7.5%. So here's what I'm thinking. Total return is dividends divided by the stock price. It's your dividend yield. Remember that dividend yield? It's got to be also your price at T, let's say 1 minus 0 over P0. So this is $1.07, 7.5 cents, divided by 14.33 plus 15.41 minus 14.33 divided by 14.33. Yeah, so what that equals, look, what that's telling you is here, your total return is 7.5% from dividends, and your capital gains is 7.5%, and that gives you 15% in total, which is your return on equity. So remember, your return on equity, that's the return of the whole firm. Well, that should be your return in this type of example. The return that the stock generates should be the same return that you generate because you own the stock. So it should be the same thing. And it is. Now, this is a very simplified example. There was no debt and there was no other activity going on, so it's quite simplified. But it does drive home the fact that, look, if the company has a return on equity of 15%, well, that should be the return you're generating on the stock, assuming the stock is following exactly the fundamentals of the company. And so you know what the fundamentals of the company are. The fundamentals of the company are the earnings and dividends, the cash flow it generates. And where does that come from? That comes from, your profitability, your asset turnover ratio, your discount rate, and your leverage. And so those are all fundamentals of the company that drive stock prices and your total return. Now, let's look at a couple of other ways to look at growth. Some less interesting, but nevertheless commonly used measures of growth. And so what we could do is we could just look at dividend growth historically. So what we could do is we could say, look, we take the dividend, we got a timeline. Take the dividend here, divide it by the dividend here, right? You got 1, 2, 3, 4, 5 periods that you're going to take this growth rate. This is a geometric growth rate, and subtract 1. So as a quick example, let's say D5 right here turns out to be $4, and your dividends right here, you can't read that, $1.25. That's D subscript 0. It's right here. So we take 4 divided by 125, take it to the 1/5 power, which is actually equal to 0.2 minus 1. And so we end up getting about a 0.262 dividend growth rate. Now that's great. Look, you just calculated the dividend growth rate, assuming compounding, so that makes sense, and that's good. But let me tell you, there's no intuition here. All it says is, look, you've averaged out the numbers. This could have, your dividends could have jumped around like this, but all you did was you looked at 2 points. You looked at this point and you looked at this point. You didn't look to see what happened. So it was $1.25, and the next thing you know, it's at $4. It could have bounced all around, so you need to know more about that. So by itself, averaging out or ironing out the dividend, it does tell you what the average is. It was 26%, but it doesn't tell you much more. But nevertheless, a lot of people use this. And they'll do the same thing with, since I just showed you that earnings per share grow at the same rate as dividend growth, then we can also put earnings per share in here also. EPS for 5, EPS for times 0, and do the same 1/5 calculation here and come up with a growth rate. There's another method of calculating growth. And that is growth is a function of sales per share and net profit margin. Okay, so let's look at earnings. Let's say earnings per share equals your net profit margin. And we just saw that a few minutes ago. That's net income divided by sales. Right? And it also is times sales per share divided by your number of shares outstanding. So you can see, look, you can see this sales cancels out with this sales because this is actually per share. And so net income, which is your net profit margin, divided by number of shares outstanding gives you earnings per share. Okay, so all I did was decompose earnings per share into its components, into its pieces. Oh, well, now let's look at earnings per share growth, EPS growth. EPS growth now is your growth in your net profit margin from, let's say, period 5 relative to period time 0 times your sales per share at period 5 divided by your sales per share at time 0, all to the 1/5 power minus 1. Ooh, let's see what that says. The way you get earnings per share growth is you become more profitable over time. Your profit margins increase. Or if they don't increase, they stay the same. You gotta, or even if these go down, then your sales per share need to skyrocket to make up for your drop in your net profit margin. So it's the combination of these two factors that are driving your earnings per share. And then you need to take it into the 1/5 power because we're calculating a geometric average over 5 periods, earnings per share compound. And so I hope you realize what we just did here. Everything compounded out. Things are compounding at this growth rate of 7.5%. And so we calculated a compound average growth rate, which kind of makes sense. This ratio, by the way, this earnings per share growth formula is very insightful because what you'll find out is that as firms get older, their net profit margins don't grow that much. They're in very mature industries and they don't grow too much. And what they do is they try to spike their sales per share to make up for this lack of growth. So when you're young firms will be highly profitable. They may not have the greatest sales per share, but they'll be highly profitable. That'll lead to sales growth. But as firms get older, their profit margins are going to stabilize. They won't grow that much. But they'll spike their sales per share, and you know how they'll do that is they'll just open new stores. So if you wonder why Dunkin' Donuts and Starbucks and McDonald's has a franchise on every corner, store on every corner, it's, they got the profit margins and they're stabilizing, but they want to grow their earnings per share because they know if their earnings per share grow, then that leads to dividend growth. Because the only way you can get dividend growth is you got to earn it. It has to be earned. And so this is where you earn it. And if your profit margins are tight because you're in industries that are maturing and businesses that are maturing, you're going to get it through sales per share. What do? You end up opening stores in the middle of nowhere. You're just trying to increase sales. And when you try to increase sales in some of the worst areas, then your profit margins are going to even fall off even more. So analysts want to see this relationship. So that's why they often ask, what are same store sales? Really good question. Same store sales. So they can back out the effect of new stores on the effect of earnings growth. Now, another thing about earnings is that, we've assumed in this video so far that G over time is constant. It looks like this. Let me tell you something. No firm in the world grows at a constant rate. It's just for modeling purposes, intuition, because if you bounce the G around, it's very hard to pin down the relationships that go on to get an understanding. So we start off with constant growth here. And then what we could do, and we will do, is we could look at growth for firms that do this over time. So this sort of young firms tend to have a very high growth rates. And then it could be that their growth drops off significantly, very quickly, and then they end up at a long-run sustainable growth. So you can think of this as long-run sustainable growth. You can think of this as long-run sustainable growth. And that when you have really high growth, it can't be sustainable for long. And this would be consistent with, for example, a patent expiring in a drug for a drug company, or sudden competition comes in, or your product becomes obsolete, then your growth will drop significantly. But you can't have really high growth forever. And it's an important point that I need to bring home to you here, is that when you have sustainable growth, you can't have sustainable growth on a real basis, meaning after you take out the effects of inflation, much more than 3 or 4%. You just can't. Which means, if you have an inflation rate of 1%, maybe you have at the max about a 5% growth rate forever. And the reason for it is this. The U.S. economy grows about 3 to 4%. There's times when it grows a little less, there's times when it grows more, but it seems to hover around 3 to 4%. And that growth comes from population growth and productivity growth, because we're just smarter and better at producing things. And so that's the underlying source for growth for the U.S. economy. So if a business has a 5% real growth rate, the sustainable growth rate, and the U.S. economy only has a 3% growth rate, it's not long before that particular business takes over the whole economy, because we're talking about taking growth out to infinity. So you don't want to have a sustainable growth rate that's higher than the U.S. economy, because then you'd have a business that is the whole economy. So it doesn't make sense to have really high growth rates with sustainable growth for an individual company. And that leads to this two-stage growth model. This is sometimes called two-stage growth. This is one stage, and this is two-stage, where this is the first stage and this is the second stage. And then you can have three-stage, where this is the long-run sustainable growth rate. This is very high, and then there's a transition period. And again, this is young firms that eventually mature, and competition comes in and eats away at their growth. So that's the nature of business. If you have long-run growth that looks like this, it's not very attractive to a lot of people and a lot of businesses. They're not going to try to steal your growth. No, they'll try to take it to some degree, but they'd much rather try to steal this growth or steal this growth. And when you have really high growth rates, it signals to the economy that you have something good, and other firms are going to mimic it and produce it and take advantage of it. And eventually your sales will come down, they'll come down, and they'll come down until you reach a sustainable growth rate. Now what I want to do is I want to estimate a three-stage growth rate. It's pretty easy to estimate a two-stage growth rate. Let's do a three-stage growth rate model. But for me to do it, I have to explain what is the growth rate here, how does this growth rate ramp down, and what the growth rate will be for the third leg of things, the third stage. So this will be stage 1, stage 2 is a transition period, and we have stage 3 growth. Now you can have many more stages of growth, but the point is this model will work nicely in saying, look, we got firms that have high growth now. It's not going to last forever. So you got to somehow build in a growth rate that comes down to reality, and it can't be higher than the U.S. economy, or this business will take over the U.S. economy. So let's estimate a three-stage growth model. Let me read you the problem. It says high-tech company is expected to grow at a rate of 15% over the next 2 years. And before we even go any further, I think the best thing for you to do is this. When you come to a multi-stage growth model, like I'm about to read to you, you need to put it on a timeline. So here's what we're going to do. Before we even go further, you'd recognize it. After you start reading the problem, you'll realize that it's a multi-stage growth model, and then you should start drawing out this timeline here. First off, it's saying Assume that high tech is expected to grow at a rate of 15% over the next 2 years. It's 15% growth here, 15% growth here. And then in year 3, it will grow at a rate 2% less each year until year 6, when it will grow at a rate of 7% forever. Okay, so there must be some inflation embedded in there if there's 7% growth embedded. So we're doing everything on a nominal basis. So it's saying it drops 2%. We need to go to year 7. So this has to be 13%. This has to be 11%, 9, and then 7. And so in year 6, so this is 1, 2, 3, 4, 5, 6. At year 6, this is the 6th year, it'll be 7%. And it just keeps going on. 7% forever. Now it says the discount rate is 18%. Okay, that's good. And let's see, the dividend starting at time 0 is $1. So that means the dividend right here is $1. And it's going to grow to $1.15 here, for example. And then what you need to do is you need to just multiply this out, compound it out. So it's a bit tedious. This will be, and I've typed it out in the notes. I'm going to round a bit, so I'll have some rounding error. D4 is $1.66. This is $1.81. And then this will be $1.94, let's call it. Okay, so we end up in dividend in period 6 here is $1.94. Now all it is at this point, it's a fairly simple problem. It's a matter of taking each one of these cash flows, because look, we did half the battle. We estimated the cash flows. Now it is a matter of discounting it all back. But there's a little problem here. There's a little problem. It's like we got this infinity sign here. That's going to bug us. So what we need to realize, so remember when I had this estimated a stock price at time 0 equals D1 divided by K minus G? That formula applies at any point in time. So if you were to jump 3 periods ahead, this would be 3. This has to be dividend 4, K minus G. And if you jump to price at year 100, it's going to be the dividend in year 101 divided by K minus G. You always have that 1 year gap. Therefore, we can take advantage of the fact that, look, we're starting right here. It's growing at a constant rate, a 7% forever. Ooh, that's kind of nice. So what we can do is we can say, look, the value of the stock price at this point in time, right, that will cover everything into the future will be V5 D6 divided by K minus G. And I'm putting it a V instead of a P because this will be the value at this point, covering all these future dates. Okay, so it'll just be the value covering this future date, and you'll see how I assemble it. But it's kind of like a price at that point in time. Okay, so what this ends up being is $1.94 divided by 0.18 minus 0.07 is that growth rate going out into the future. And this comes out to be 17.59. But then we have to discount it back 1, 2, 3, 4, 5 periods. So you make sure you can count it with your fingers. It's 1 period, 2 periods, 3 periods, 4 periods, 5 periods. So we need to discount this at 18% for 5 periods. Now what we also have to do is take into consideration the dividend that we got right here. And we're going to get this dividend too. And so that dividend is $1.81. So present value of the 5th dividend, that's what that stands for. The present value of the 5th dividend is 181 divided by 1.18 to the 5th power. So we're discounting this dividend. So this turns out to be, oops, I should write this out. This says 7 7.69, and this comes out to be 79 cents. So what I'm saying, let's be clear here. This dividend right here, the present value of that dividend is 79 cents today, discounted back 5 years at 18%. Then we considered all of the future cash flows, and all of the value of all those future cash flows was $17.59, but then you had to discount it all back. It turns out to be valued at times zero, meaning present value, $7.69. Now what we need to do is take the present value of this dividend, this dividend, this dividend, this dividend back. This dividend was already paid, remember? It's right before this point, so we don't need to consider it. So we take the present value of dividend 4, and that's 1.66 divided by 1 plus 1/8 to the 4th power. And that'll be 86 cents. Running out of space. That will equal 97 cents. And let's see, it comes out to be $12.17. That's an estimate today of the stock price. Present value of the future dividends, assuming variable growth. And so here you got constant 15%, so it kind of looked like this, 15%, then it transitioned, and leveled off at a sustainable growth rate of 7% over time. And this would be G here. Now, before we end this video, let me give you some advice on how to actually implement the dividend discount model. First off, you probably want to apply it to stocks with dividends. You don't have to have a stock that pays dividends, because you can assume for, the next 7 years, for example, it pays 0 dividends. And then eventually, as the company matures, it'll start paying a dividend. And so in year 7, you can start up that dividend and get it growing. So you probably want to apply it to a dividends paying stock, but it's not necessary. You can apply this model, the dividend discount model, to portfolios. So you can apply it to the S&P 500. So you'd get the S&P 500 dividend for the whole index, which would be weighted by the weights in each stock in the index. And you'd get a dividend for the entire S&P, and then you'd come up with a discount rate for the S&P. You'd probably assume a beta of about 1 because it would present the market. Then you'd have to come up with a sustainable growth rate. The sustainable growth rate may actually be a little higher than 3 or 4% that I told you. And the reason is this. The composition of the S&P 500 is decided by a board who take out the laggards and bring in new companies. And so the index churns over time. And those big companies often buy out other companies, and so they get their growth from buyouts. They're buying out other companies and generating earnings per share growth, which leads to dividends per share growth. The models that we've been looking at, and kind of the assumptions that were embedded under there, it's almost as though we're looking at a company that was in a single product or close to it, and that is, eventually the company settled down to a long-run sustainable growth rate because its product became mature and in a mature market. But in a lot of these S&P 500 companies and the Dow and the NASDAQ companies, they're so large they can afford to go out and buy other companies in niches that they just didn't have the ability to do internally. So what I'm saying is, when you look at the Dow index, which is sometimes churning as they drop out some of the poor performing stocks and add new ones, does really well over the very, very long run, which means the growth is, maybe 10, 12% per year on average because of these special situations going on with these large companies. My other advice is to always apply the constant growth model right off the bat. It's back of the envelope calculation. It's really quick, provided the stock is not a super high growth rate stock, and then right away it doesn't apply, and it may not even make any sense because you'll end up with a growth rate that's higher than the discount rate, and you'll get a negative stock price, but that's really an infinite stock price. So if you have stocks that are reasonable, in the ballpark growth, then what I would do is I'd apply the constant growth model just to get an estimate first off, and then move to probably a 2-stage or a 3-stage growth model before I go any further as a next step.